Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Private equity has backed many of the recent acquisitions in the RIA profession. Indeed, approximately 77% of transactions in the first quarter of 2023 involve private equity funding. Many of the largest acquirers are backed by PE firms, and that includes Mariner, Carson, Mercer, Focus, Savant, Pathstone, the Wealth Exchange Group, and many others. When evaluating a PE-backed acquirer, there are a few things to consider, including possible drawbacks and how it will impact the future of your firm. And here to discuss that is John Furey, the managing partner of Advisor Growth Strategies, AGS. AGS is a management consulting and transaction advisory firm exclusively for financial advisory firms and institutions looking to aggressively grow or solve a key management challenge. Since its founding in 2009, John and his team have consulted with more than 300 firms nationwide, representing more than 450 billion in investable assets. So, John, let's start off by having you tell me about your career path and what led you to start AGS.
Yeah, thanks, Bob. It's great here to be with you. Yes, I started AGS in 2009. Prior to that, my career was with Charles Schwab and Company, primarily in their registered investment advisor custody channel, where I had sales and what's called practice management roles. So I had a great career there as a managing director. And when I departed, I helped build and architect their national program to help wirehouse advisors or captive advisors start their own fiduciary firm, their own registered investment advisor. So that was the launch point for AGS. I had conviction that large, sophisticated teams needed help beyond what Schwab could do or was willing to do, maybe a better way to think about it. So we built a platform for it where we had a proposition to those advisors to say, hey, building a small business is hard. We'll be your outsourced, think general manager to build your firm, and then we'll hand you the keys, and now you can get up and running and fly with your new entity. And then since then, it's evolved where we're doing practice management work for advisors, and now, of course, mergers and acquisitions, which is our topic for today.
Well, let's delve into that topic, focusing on private equity. Why are so many private equity firms so interested in the RIA space?
Wealth management and the RIA space has been found out by those firms, PE firms, also family offices, let's call it private investors. And why that is really one, as we all know, this secular trend moving away from captive channels, wirehouses and banks, and more to a more fiduciary model. So that's one. So the tide of wealth management, think US households and their preferences for where their money should be managed, is moving towards the RIA space, and that trend's been happening for well over a decade. The other why is private investors love recurring revenue models, and this channel offers that. So there's predictable revenue, there's predictable profitability, and if you're a great operator, there's also predictable growth, which PE investors love to hit their return model. So I think that's the main reasons why. It's just the nature of these businesses. And now the other trend that's happening is RIAs. When I first started in this industry, we were very small. What was big? I think $1 billion AUM firm, that was like, wow, that's large. But it wasn't large. It might have been 15, 20 people, billion AUM, maybe top line of 8 million, profit of 2 million. But now if you look at firms that are 10 billion, think 10x what used to be defined as large, it's now viable for a private equity firm to deploy capital in a firm like that, because these firms can be worth 100 million, 200 million. And then some of the largest firms that you referenced at the start, even over a billion in think firm valuation. So now private equity can actually deploy capital in a way they couldn't a decade ago. So size matters. That's why.
So we've seen the growth of the fiduciary channel, the recurring AUM based model, and the fact that these PE backed firms can deploy large amounts of capital because the target companies are much larger than they were 15, 20 years ago. Talk about some of the recent large deals that you've seen, maybe some of the industry events that might highlight some trends that are happening in this space.
Yeah, there's been some incredibly large transactions by PE firms. I think you look at, you know, multiple ones, whether it be Focus Financial's recap going from the public markets to private, the Carson Group taking an investment by Bain, and then maybe even a Beacon Point by KKR. Like these are headline PE firms, some of the largest PE firms in the United States, which I think would have just been, if you would have asked myself or others who are really involved in these things, if that was achievable, even 5 years ago, I think you probably would have got a lot of laughs about it. So I think these larger deals, these headline deals, one, they've set a new mark for valuation because the valuations went off at 20 times or more free cash flow. Think EBITDA as we use in our industry. So I think one, it's raised the value of the industry in aggregate. It trickles down, right, to even smaller firms. And I think two, it solves for one of the biggest challenges this industry has, which is liquidity for founders and for owners of these firms. Meaning you work, as a great fiduciary, you start a registered advisor, you grow it, you nurture it, you develop your team. And then when it comes towards, think harvesting your life's work, how to get liquidity and an outcome, as an owner, these PE firms, especially the larger ones, play an incredibly valuable role because they're helping with the value of these firms. They're bringing in more professional management into these firms, which, I feel strongly that contributors of these firms and also the clients, most importantly, are getting better outcomes because of these large firms coming in, PE, they're just bringing more discipline, more business know-how, which I think benefits all.
So, one of the key benefits is professional management, a more disciplined approach. Talk some more about what the other benefits are, maybe what some of the drawbacks are to a firm that's being acquired by someone that's backed by private equity.
Yeah, I think one, of course, is capital, right? That is a huge benefit. And how can capital be deployed? So it's always the source of the capital, which is PE, and then it's the use of the capital. So benefit number one, think use of capital, think the investment itself. I mentioned liquidity. The second is to fund, think transactions. Think, these firms are all out there trying to buy smaller registered investment advisors and provide those benefits. And the capital matters, right, to fund M&A transactions. Then beyond just the money, which you could argue, PE, A, B, C, D, E, the capital is somewhat table stakes, right? Anyone can, raise money, raise funds, and then deploy it in an RIA. But what else do they do for the RIA? And that's where we're leading to. One is professional management. So think formal board. A lot of RIAs have maybe an advisory board, but private equity brings a true fiduciary board. Think board seats and think real governance and oversight. So for me, it modernizes these firms, grows them up for more professional management. And then really for me is also helping firms think through issues more strategically. Sometimes, I founded a firm, operate a firm. For some of these RIAs, it can get very insular. There's not a lot of outside thinking outside of what we live and breathe every day in the RIA ecosystem. So PE firms invest in other industries, so they bring that, maybe third party perspective, which I think helps with blind spotting. What's, there's one thing to know what's in front of you, but there's something else to have wisdom around what's unseen in maybe a large business. So I think it's just that business know-how. And then finally, some of these firms have unique strengths, whether it be, we've met PE firms that are really good in technology and helping, think their portfolio companies advance that way. It could also be sales and marketing, could be branding. So some PE firms have unique strengths, think functional unique strengths that could help propel the business forward. So I think those are the main benefits. Let's talk a little bit about drawbacks. I think, yeah, sometimes PE can get a little bit of a black eye where it's more, hey, if you take outside capital, you don't really control your firm anymore. If you're a registered investment advisor, it could be bad for the client because it's all about the money for the PE firm, and they might, try to exert undue influence to make, founders do something they don't want to do. I haven't seen any evidence of that. I think it's been the opposite, because what the PE investor wants is to hit a return model and get an outcome. But how they do it is they invest in the firm, which again, for me, strengthens the team, and then also strengthens the client experience where clients benefit. So if I was going to say there's a major drawback, and I'm not even quite sure if it's a drawback, but one, there's accountability, greater accountability, and that's through that governance framework I reference as a benefit. And some RIAs might not like that. And then the other piece is PE firms do have a return model and an investment horizon. So if you take money from an outside investor like PE, you really have to understand what they're looking for, what their end game is, because they might, try to get out of their investment, then get liquidity for their investment in a 5 to 7 year period, and the RIA may have to find a new investor. I think those are the primary drawbacks.
I'm going to come back in a little while to the what you call the black eye that has fallen upon some of the PE-backed firms, but let's focus more on the RIA owner for now. And what would you say to someone who is thinking of partnering with a firm that's PE backed? What does the math look like? What are the payouts? What are the numbers? What's the trade offs that they'll be making financially?
Yeah, I think if you're an owner of a registered investment advisor and you're thinking, hey, it may make sense to partner with one of these PE backed firms, first you have to think through, well, why do you want to do it? And it has to be beyond just money. I'm going to sell my firm and get, an outcome consideration. There has to be a valid reason to do it. So what are the reasons? One could be business continuity. Maybe you have not been able to install a next generation team, think a G2, generation 2, to essentially recycle the ownership, so that it might make sense to do a deal because they provide greater business continuity. They're not throwing you out the door if you're an owner, but they're larger, which size essentially reduces risk. So there's a greater probability with, maybe a PE backed firm to provide your office, your team, your clients with business continuity, which is a real risk. So it's growth, continuity. And then I think the other piece, and this became very acute with COVID, is operating an RIA is not, it's not easy, right? Being a small business owner. And I think what happens over time is, one, if you've been managing a firm or a partner group for a decade or more, some advisors just want to go back to being an advisor professional and work with clients and not have to worry about the compliance, the technology stack, all these things that it takes to run a firm in today's modern world. So I think that's incredibly important, that piece. And then to get down to the math equation, which was the other part of your question, like, well, what does it mean? You do a deal, what does it mean? At a high level, you do a deal with a PE backed firm, you're likely going to get cash, maybe some equity in the PE firm to align interests. The PE back firm may want you to take equity to make sure you're all in the new partnership. Then there's usually some contingent consideration based on growth. You're thinking 2 or 3 years post closing the deal. If you do well, you can get a second bite at the apple, and then you get some sort of compensation agreement with that for the owners and the professional team. So brass tacks, well, what are the numbers? Our research shows now that valuations have essentially flatlined, but for the median multiple now is around 10x EBITDA. And I think with that, no owner should say, "Hey, that's my number." It could be lower, even as low as think like 6, 7 times EBITDA, or even higher. I think 14x or more, depending on the value of your firm. And we could talk a little bit about valuation drivers as well.
The future is fast approaching, and artificial intelligence is positioned to fundamentally change not only society, but financial advisory. Join us on August 30th for VettaFi's AI Symposium, where experts and thought leaders dig into AI and explore its potential impact. Go to etftrends.com/webcasts/artificial-intelligence-symposium.com to learn more and register for the event.
I'd love to hear about those valuation drivers, but first I'm wondering, we've gone through a period over the last, say, year and a half where rates have risen considerably. Has that affected the level of interest from PE investors, or have there been any other macroeconomic or risk-based factors that have dampened or increased interest?
What has happened? Interest rates, as we all know, there's a correlation between rates going up and maybe valuations dropping just because the cost of capital is higher. Now, so that's real. So that's why we had this steady ascent of valuations. Now it's kind of flatlined. You could even argue gone down a little bit this year. PE is still interested. Interested right now. What's a little bit different now is structure of deals. So there's a little bit more risk being put to think the platform, the firm PE is investing in. So it's more, okay, we're going to invest in you. Now we also need to see growth in the transaction. So there's a little bit more structure to it, I think, one. But if anything, from our perspective, PE interest hasn't gone down. It's actually gone up. And I think the reason for that is the registered investment advisor channel has demonstrated stability and now coming out of maybe a little bit of a market decline growth. So it hasn't waned. I think PE firms are still interested in making investments, and we're extremely active, my company, working with our clients, evaluating, maybe a PE investment in our clients.
When you say that more risk is being borne by the acquiree, the RIA firm, how does that specifically play out? Is it in a contingent payoff that's dependent on growth and profitability? And also talk about more generally what you are seeing in valuations.
Bob, that's exactly right. So most deals at this point are, think, one way in structure, where the PE investor will make their investment, and then the RA has the opportunity to improve, think, the valuation based on growth. So I think it's still advantageous, maybe not that high of a risk for an RA to take money. And then the valuation, how PE is evaluating RAs, it's really dependent on a couple of things. One is growth, as I mentioned. Two is size, and then three is the quality of the team. So I think those things, as they come together, are all really, really important. Valuations for direct investments can be all over the map. Even still, I mentioned some of these headline firms achieving multiples of 20x. That's not for, the smaller RIA that's 5, 10, even 15 billion in AUM and has a pretty good growth rate. The expectation should be lower. Think around 13 to 16 times the cash flow, something to that effect, but still much higher than, maybe, what we see as a median investment of deals, which essentially macro for the industry is about 10x.
What do you see as the overall impact of private equity on the future of the RIA profession? How's it all playing out?
Yeah, I think what PE is driving is there, a lot of pundits maybe in the industry call industry this effect called industry consolidation, which means less firms and far larger firms. But I think it's more concentration where PE is making or is helping firms get very large. So there's very, very large firms, but I don't think it's consolidation per se because there's still plenty of startups that are happening in the industry. If you look at it from a macro perspective, registered investment advisors registered with the SEC, there's essentially been about the same amount of RIAs for like the past 5 years in and around 15,000 RIAs. So it's not like the industry is being rolled up, but it's becoming a lot more concentrated. Our research shows, and the numbers, a bit dynamic, that if you look at firms that are 10 billion in AUM or more, and there's about 300 of them in the United States, they control north of 85% of the assets in the channel. So think 300 firms out of 15,000 controlling 80% of the 85% or more of the assets. So that's concentration, and PE is only going to continue to drive that.
Any other important trends that you're seeing?
Yeah, I mean, I think that some of the big things, and it's playing out in the consulting business, what PE has done, and it's a great benefit because they're helping with valuation and liquidity. But given that fact, think if you're an owner of a firm and you've marked to market what you could achieve with, maybe selling to a PE-backed firm, it's making internal transitions a lot more challenging. So think if you're a firm that wants to get equity into the hands of your G2, it's pretty hard to expect a next gen contributor, a great advisor, a great professional to pay what a PE firm can pay for equity in a registered investment advisor firm. So most internal transactions historically, we've been in business over a decade. We're structuring internal succession plans or the purchase of equity, anywhere from, for reasonable RIA, I think, 5 to 7 times the cash flow of the EBITDA. And that's gone up a little. But if you look at it, and if you're a firm and you're like, wait, I can sell my equity internally for this number, but it's a far larger number outside, it makes recycling equity or selling equity within a firm a bit more challenging. So what we're seeing in our consulting business, it just requires a lot more creativity for us to get internal equity transactions done. So that is real. So, and the other thing, if a firm decides to go to market and partner with a PE-backed firm, really requires alignment with the team, right? What's in it for them? So when we think with our clients that they're going to do a deal with a PE-backed firm, it's like, look, it's just not just the founding partner outcome. How are we going to help the next gen contributor see a career path and see the win and see the opportunity with the new partner? So it's incredibly important that RIAs think that all the way through. It's not just about the founder outcome, the owners, the partners, the existing partners. It's also the next gen team, and then of course the clients. So that alignment has to be there. So that trend is incredibly important.
Well, I want to come back to a point that you mentioned earlier, which is the black eye that has befallen some PE firms in this environment. Let's start with this. I mean, there's an internal inherent conflict of interest when a financial institution like a PE-backed acquirer owns a fiduciary advisor, because the advisor always has to act in the best interests of its clients, but the acquirer is bound to act in the interests of its shareholders, particularly its general and limited partners. You must have seen some situations where this conflict has played out. You mentioned earlier that private equity firms are motivated to hit a return, and they do that by investing in the business. Haven't there been instances you've seen where they've also decided to hit that return by cutting back on expenses?
Yeah, I think it's a valid concern. If you look at where can friction happen between the investor and let's call it the operators, it's maybe what happened last year is when markets go sideways, right? Market goes against you, it's hard to grow the top line revenue, and think of a board. If you're a board member with the team and the PE firm, all of a sudden things are getting tight and you have to think through it. I think what you're referencing, how it's playing out for all the listeners there, is when you see things like management team changes. I think that's one is like, hey, do we have the right management team that can survive any durable market? And a PE investor, might lose, patience or whatever it may be, or think the owners of the firm, you know, might choose to be less involved. Just played out with Allworth, right? If you look at Allworth and the founders there, for all the right reasons, decided to step aside. Happened with Mercer. Dave Welling came in, Schwab executive, peer of mine, and we worked together, came in and operated the firm. So I think that's where that kind of plays out because the PE investors all in, right? Because they made the investment and they don't want friction. They want growth out of it and great outcomes. So I think that's where that friction happens is like, look, things are going sideways. Do we have the right team to get us through these sideways markets? So I think that's where that comes in. It's not, there's no PE firm that's going to say, hey, let's just, slash expenses, run this thing to the bone to get a return out of it. They're thinking differently. It's like, look, we have a long-term investment in this firm and we want to grow it together. So I think, if you're going to see any friction, it's going to play out in think management team changes.
So PE has gotten a bad reputation beyond the advisory world, really across many industries in the United States. And in our publication, we recently reviewed a couple of books about this. Brendan Ballou had a book called Plunder, Private Equity's Plan to Pillage America. Gretchen Morgenson and Joshua Rosner had a book called These Are the Plunderers, How Private Equity Runs and Wrecks America. The underlying theme there was that PE firms act to maximize the general and limited partners' returns, and they do that at the expense of the employees, the customers, and the communities where firms operate. How do you respond to those concerns, and how should an advisor respond when they read one of those books and read the tales of some of the failures that have befallen private equity?
Every advisor firm, RIA, that's considering a transaction, either taking on PE investment from the investor direct or doing a deal, you need to be educated and you need to understand who the investor is and the outcome that they are looking for. So that's one, that's fundamental. You can't just simply look at the proposed transaction and say, oh, here's the number, here's the multiple. I like the multiple, I'm going to do the deal. Because what matters more is what life looks like over the wall, like you're saying, 2 to 3 years down the line. And you need to understand if the PE firm's in, they want the things I was referencing earlier. They want growth, they want liquidity. Like, what does that mean? So tactically, you need to do your diligence, which is understanding the investor, one, understanding technical things like the operating agreement, understanding the track record of the PE. What are the outcomes been for their portfolio companies versus blindly taking a valuation? So, because if you do, you might, like I was saying, go over the wall and you might not like, how that chair feels when you're sitting in it.
Well, you've already answered what my final question was going to be, but I'll pose it anyway because maybe you can add to it. If there's one key takeaway that you would like to leave with our audience of advisors about the diligence that they should perform on a potential PE-backed acquirer, what would that be?
Yeah, I think there's some of the technical things I referenced about, think understand the operating agreement, the PE investors return model, what they're looking for, things like that. But I also think we have to remember that the RIA industry, we're not building widgets here, right? It's all a relational business. It's a relational business between the advisor and the client. Think the owners and their team, and think the owners or advisors with the investor themselves. So you really have to understand the team you're getting too, because it is a relational business. We've seen deals happen where if there's a great cultural fit, you forego a little bit of valuation to get the right culture fit, and that matters. So if you're going to think about doing a deal with the PE firm, you better know the partners of the firm, what they're looking for, and make sure that they fit in the culture you're trying to work in.
Well, thank you. And we'll include some links in the notes that accompany this podcast where you'll be able to learn more about John and advisor growth strategies. There'll be a link to the AGS website, a link to John's bio, a link to an article that John wrote in Advisor Perspectives a few months ago called The Permanent Role of Private Equity in the RIA Profession. And lastly, there'll be a link to the AGS annual report, which is called the RIA Deal Room. It shares real-time data-driven M&A industry trends that look at the mechanics and underlying transactions. John, is there anything else you'd like to add?
No, that's it, Bob. It was great to be with you today.
Well, thank you very much, and thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring John Furey of Advisor Growth Strategies. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.